Let me ask you something. You spend your entire life working, 40, maybe 45 years of getting up early, paying into the system, saving where you can, planning carefully. You and your spouse sit down together, maybe with a financial advisor, maybe just at the kitchen table, and you figure it all out. The Social Security checks, the pension, the retirement account withdrawals. You do the math. The numbers work. You feel good about it. You feel secure. And then one morning, everything changes. Not because of bad investments, not because of inflation, not because of anything you did wrong, but because your spouse passes away. And suddenly, overnight, the income that was supporting two people doesn't just drop a little. It drops by nearly 40%. And the bills, they don't drop by 40%. The rent or mortgage doesn't drop by 40%. The utilities, the insurance, the groceries, the prescriptions, none of it drops by 40%. That gap, that brutal, painful, and completely legal gap, is what financial experts call the widow penalty. And if you are married and retired right now, or if you are planning your retirement as a couple, this is the most important thing you will watch today. Stay with me, because by the end of this video, you are going to understand exactly how this penalty works, why the system is built this way, what the IRS quietly does that makes it even worse, and most importantly, what steps you can take right now to protect yourself or someone you love from being blindsided by it. I'm Jason. Welcome to Jason Retires. If you are new here, this channel is all about helping everyday Americans navigate retirement with confidence and clarity. No confusing jargon, no scare tactics, just honest, real conversations about the money stuff that actually matters. If that sounds like something you want more of in your life, go ahead and hit that subscribe button right now, because we publish new content every week and you do not want to miss what is coming up. And if you know someone who is married and retired, or getting close to retirement, please keep this video in mind, because what we are talking about today could genuinely change their financial future. Now, let's get into this. Let's really dig in, because the widow penalty is one of those things that sounds like a financial buzzword until it happens to you or someone you love, and then it feels like the ground just dropped out from underneath your feet. So here is how it works in the most straightforward way possible. When two people are married and both collecting Social Security, they each receive their own benefit check every month. Maybe the higher earner is getting $2,200 a month. Maybe the lower earner is getting $1,400 a month. Together, that household is bringing in $3,600 every single month from Social Security alone. That feels manageable. That covers a lot. But when one spouse dies, the surviving spouse does not keep both checks. They keep only one. Specifically, they keep whichever check is larger. So in our example, the surviving spouse now has $2,200 a month instead of $3,600. That is a loss of $1,400 per month. That is $16,800 per year, gone. And this happens automatically, immediately, with no gradual phase-in and no warning period. Now you might be thinking, okay, that is tough, but surely the expenses go down too when it is just one person. And yes, some expenses do go down slightly. But here is what the research actually shows. Studies from the Employee Benefit Research Institute and the Center for Retirement Research at Boston College consistently show that a surviving spouse typically needs somewhere between 65 and 75% of the couple's previous income just to maintain the same standard of living. But after the widow penalty hits, they are often left with 50% or even less. That is not a small gap. That is a gap that forces people to make impossible choices. Do I pay for my medication, Or my heating bill? Do I stay in my home, or do I sell it? Do I ask my children for help, or do I just quietly struggle? And here is something that is almost never talked about. The widow penalty does not just come from Social Security. It comes from multiple directions at the same time, and they all hit at once. Let's walk through each one, because this is where it gets really eye-opening. The first direction it comes from is Social Security itself, which we just covered. But the second direction is pension income. If the deceased spouse had a traditional pension, what happens to that income depends entirely on what survivor benefit option was chosen at the time of retirement. If the retiree chose what is called the single life annuity option, which pays the highest monthly amount, that income completely stops when that person dies. Zero. Gone. And unfortunately, a lot of people choose the single life option because it gives them more money each month. And they either do not fully understand the trade-off, or they assume they will outlive their spouse. But statistically, women outlive men in the United States by an average of about 5 to 6 years, according to data from the Centers for Disease Control and Prevention. So in the majority of cases, it is the wife who is left behind. And if her husband chose the single life pension option, she loses that entire income stream the moment he passes. Now, some pension plans do offer joint and survivor options, where a reduced monthly payment continues to the spouse after the retiree dies. But even in those cases, the reduction can be significant. A 50% joint and survivor option might reduce the monthly pension benefit by 15 to 20% while both spouses are alive, and then the surviving spouse only receives half of that reduced amount. It is a trade-off that requires very careful calculation, and a lot of couples never have that conversation clearly enough before they have to make the decision. The third direction the widow penalty comes from is taxes. And this one is the sneaky one. This is the one that even financially savvy people often do not see coming. When you are married and filing jointly, you get to use the married filing jointly tax brackets. For 2024, a married couple filing jointly pays zero federal income tax on the first roughly $30,000 of income above their standard deduction, and the standard deduction itself for a married couple filing jointly is $29,200. But when one spouse dies, the surviving spouse can only use the married filing jointly status for the tax year in which the death occurred. After that, they file as a single person, and the single filer standard deduction for 2024 is only $14,600. That is exactly half. So immediately, the surviving spouse has a higher taxable income, even though their actual income went down. And the tax brackets for single filers are compressed compared to joint filers, meaning income gets taxed at higher rates much sooner. This phenomenon is so well recognized in the tax world that it has its own name. People call it the widow's tax bomb. And according to analysis from multiple retirement planning organizations, it can result in a tax bill increase of anywhere from $2,000 to $10,000 per year for a surviving spouse, depending on their income sources and the size of their retirement accounts. Let me say that again, because it is important. Your actual income goes down. Your tax bill goes up. That is the widow's tax bomb. And it is completely legal, and it happens to thousands of Americans every single year. The fourth direction involves healthcare costs, and this one is particularly painful. Medicare premiums are income-based through a system called IRMAA, which stands for Income-Related Monthly Adjustment Amount. When your income is above certain thresholds, you pay higher Medicare Part B and Part D premiums. Now here is the cruel irony. As a married couple, those income thresholds are higher, so you might be paying standard Medicare premiums. But after your spouse dies and you start filing as a single person, those income thresholds drop significantly. In 2024, the IRMAA surcharge for single filers kicks in at $85,000 of modified adjusted gross income, compared to $170,000 for married couples filing jointly. So a surviving spouse with, say, $100,000 in annual income could suddenly find themselves in a higher IRMAA bracket, simply because they are now filing as single, not because their income actually changed that dramatically. This can add hundreds of dollars per month to their Medicare costs. And remember, this is happening at the same time that their income dropped because of the Social Security and pension changes. So let us add this all up in a real-world scenario. Let us take a retired couple named Richard and Carol. Richard gets $2,400 a month from Social Security. Carol gets $1,500 a month. Richard also has a pension that pays $1,800 a month, and he chose the single life option because it paid more. Together, they have $5,700 a month coming in. That is $68,400 a year. They own their home, they manage their bills, and they feel stable. Then Richard passes away. Immediately, Carol loses his $1,500 Social Security check and keeps only Richard's larger check of $2,400. She also loses the full $1,800 pension check because Richard chose the single life option. Her income is now $2,400 a month, which is $28,800 a year. She has gone from $68,400 a year to $28,800 a year. That is a 58% drop. And her bills have not dropped by 58%. Her property taxes are the same. Her homeowner's insurance is the same. Her utilities are nearly the same. Her food costs went down a little, but not much. And now, she is facing all of these costs alone, possibly with additional expenses related to Richard's final medical care or funeral costs, and possibly with the tax and Medicare premium changes hitting her at the same time. This is not a hypothetical horror story. This is the real financial reality that hundreds of thousands of American widows and widowers face every single year. The Social Security Administration processes roughly 2 million survivor benefit applications annually. 2 million. This is not rare. This is common. And yet so few couples plan specifically for this scenario before it happens. So what can you do about it? Let us talk about that. Because knowledge is only useful if it leads to action. And there are real, practical strategies that can significantly reduce or even eliminate the widow penalty if you plan ahead. The first and arguably most powerful strategy is to maximize the higher earner's Social Security benefit by delaying it as long as possible. Here is why this matters so much specifically for the surviving spouse. When one spouse dies, the survivor keeps the higher of the two Social Security checks. So if the higher earner delays their benefit until age 70 instead of claiming at 62 or even 66, their monthly benefit can be significantly larger. The difference between claiming at 62 versus 70 is approximately 76% in benefit size, according to Social Security Administration data. So if the higher earner would have received $2,000 a month at 62, they might receive around $3,500 at 70. And that $3,500 benefit is what the surviving spouse keeps for the rest of their life. This single decision, the timing of when the higher earner claims, can be one of the most important financial decisions a married couple makes for their long-term security. The lower earner can claim earlier if needed, providing income while the higher earner delays. This is sometimes called the claim and delay strategy, and many financial planners who specialize in retirement income use it specifically to protect surviving spouses. The second strategy involves pension decisions. If either spouse has a pension, it is absolutely critical to understand all of the survivor benefit options before making an irrevocable election. Yes, the single life annuity pays more each month, but the joint and survivor option is essentially a form of life insurance for your spouse. Some people choose the single life option and then purchase a separate life insurance policy to compensate for the loss of income if they die first. This is sometimes called pension max, and whether it makes sense depends on the cost of the life insurance, the age and health of both spouses, and the size of the pension reduction. This is not a simple calculation, and it really deserves careful analysis with a qualified financial planner. But the critical thing is that you have this conversation and understand your options before you retire. Because once you retire and make your pension election, you generally cannot change it. The third strategy involves Roth conversions, and this one directly addresses the widow's tax bomb. If you have money sitting in traditional IRAs or traditional 401k accounts, that money will be taxed as ordinary income when you withdraw it. For a surviving spouse filing as single, those withdrawals will be taxed at higher rates than they would be for a married couple filing jointly. One way to reduce this future tax burden is to do Roth conversions before the death of a spouse. Ideally during the early years of retirement when you may have lower income before required minimum distributions kick in. Converting traditional retirement funds to Roth means you pay the taxes now at what might be lower rates so that future withdrawals are tax-free. A surviving spouse can withdraw from a Roth IRA without triggering the tax bracket compression that hits traditional accounts. This is a strategy that requires coordination with a tax professional, but it is one of the most effective tools available for reducing the long-term tax impact of the widow penalty. The fourth strategy is life insurance, and I know that some of you may have heard that you do not need life insurance in retirement because the kids are grown and the mortgage might be paid off. But for married retirees, life insurance can serve a very specific and important purpose, which is income replacement for the surviving spouse. A permanent life insurance policy with a death benefit sized to replace the lost income can bridge the gap that the widow penalty creates. The cost of that coverage depends on age, health, and the amount of coverage needed, so this is something to evaluate carefully. But the concept is straightforward. If your spouse's death will reduce your household income by $1,000 or $1,500 or $2,000 a month, what would it cost to insure against that loss? That is a question worth answering before you find yourself in that situation. The fifth strategy is one that not enough couples do, which is to specifically model the surviving spouse scenario in their retirement plan. Most retirement planning software and most conversations with financial advisors focus on the couple together. They project income and expenses for two people. But you should specifically ask your advisor or work through it yourself. What does this plan look like if one of us dies 5 years from now, 10 years from now, 15 years from now? Run the numbers for both scenarios, because the plan that works perfectly for two people might leave one person in serious financial trouble. Seeing the numbers in black and white before a crisis forces you to look at them, gives you the opportunity to make adjustments while you still have options. Now, beyond individual planning strategies, it is also worth understanding some of the broader context around why the widow penalty exists and whether there are any policy-level changes happening that might affect it. The structure of Social Security survivor benefits has been largely unchanged for decades. There have been various proposals over the years to reform survivor benefits, including proposals to allow surviving spouses to keep a larger percentage of the combined benefit rather than just the higher of the two individual benefits. Some researchers and advocacy groups have proposed a 75% combined benefit for survivors. Under this approach, if a couple was receiving a combined $3,600, the surviving spouse would receive $2,700 instead of just the $2,200 single benefit. That would be a significant improvement for millions of people. However, as of the most recent legislative activity, no such reform has been enacted, and the existing rules remain in place. This is something that advocacy organizations like AARP have been pushing for, and it is worth staying informed about as policy conversations continue. It is also worth noting that the widow penalty disproportionately affects women. According to data from the Social Security Administration, women make up approximately 80% of all surviving spouses receiving Social Security widow benefits. And women's retirement savings are historically lower than men's due to wage gaps, career interruptions for caregiving, and longer life expectancy. So the widow penalty tends to fall hardest on people who are already in a more financially vulnerable position. A 2023 report from the National Institute on Retirement Security found that women aged 65 and older experience poverty at nearly twice the rate of men in the same age group. And the loss of a spouse's income is one of the key drivers of that disparity. This is also why financial literacy, specifically for married women in retirement, matters so much. In many traditional households, one spouse handles the finances and the other does not fully understand the details of their income sources, accounts, and benefits. If the spouse who handles the finances passes away first, the surviving spouse may suddenly be navigating all of these complex decisions during a period of grief, and they may not have the information they need to make good choices quickly. It is deeply important for both spouses to understand the full picture of their retirement income, where it comes from, how much it is, and what happens to each piece if one of them is gone. One more thing I want to mention before we wrap up, and this is something that a lot of people do not realize is even possible. If you are a surviving spouse and you have not reviewed your financial situation since your spouse passed, it is not too late to make improvements. Depending on your circumstances, there may be opportunities to adjust your tax withholding, to look at your Social Security claiming status more carefully, to evaluate whether any annuity or life insurance benefits your spouse may have had are being fully claimed, and to review your investment allocation to make sure it still matches your current income needs and risk tolerance. Working with a fee-only financial advisor, someone who is paid directly by you rather than through commissions, can be particularly helpful during this transition. You want someone whose advice is aligned with your interests, not someone who benefits from selling you products. And if you are caring for an aging parent or a relative who is widowed, please make sure they have someone trustworthy looking at these numbers with them. Financial predators specifically target widowed seniors because they know this is a vulnerable time when people may be overwhelmed and not at their sharpest when it comes to financial decisions. Having a trusted family member or advisor in the picture is one of the most protective things you can do. Here is what I want you to take away from everything we have covered today. The widow penalty is real. It is not a glitch or an oversight. It is built into the structure of our retirement income system. Social Security survivor rules, pension elections, tax brackets, Medicare premium thresholds, all of them work in ways that can dramatically reduce a surviving spouse's income and simultaneously increase their tax burden and healthcare costs. The impact can be a drop of 30, 40, 50% or more in household income, often happening at one of the most emotionally difficult times in a person's life. But it is also plannable. It is something you can see coming if you look for it. And the earlier you look at it and plan around it, the more options you have. Delaying the higher earner's Social Security claim, choosing survivor-friendly pension options, doing Roth conversions to reduce future tax exposure, using life insurance for income replacement, modeling the surviving spouse scenario explicitly in your retirement plan. These are not exotic strategies. They are practical tools that thousands of thoughtful retirees use to protect their families. I really hope this video has opened your eyes to something that does not get talked about nearly enough. And I want to know what you think. Have you thought about the widow penalty in your own retirement planning? Did you already know about this, or was this new information for you? Drop a comment below and tell me where you stand. Were you aware of the tax bracket issue specifically, the part about the standard deduction getting cut in half? Let me know. I read every single comment, and your responses genuinely help me shape the content I create for this channel. If this video helped you understand something you did not fully know before, the single best thing you can do right now is share it. Send it to your spouse, your sibling, your parents, your friend who is getting close to retirement. You might just be the reason they have a very important conversation that changes their financial future. That is not an exaggeration. Sometimes one piece of information at the right moment changes everything. And if you are not subscribed yet, please subscribe now and turn on notifications. We are going to keep bringing you content on exactly these kinds of topics, the things that retirement planning books often gloss over, the real-world financial situations that real Americans face. On Jason Retires, we take that seriously, and we are not going anywhere. Thank you so much for watching all the way through. I will see you in the next one.